All right, the last lecture we did was IAS 16. And I told you that in IAS 16, the assets are the tangible non-current assets. And those assets are held for use in the production or the supply of goods or services or rental to others or for administrative purposes. Let me just write it. That in the last lecture we did IAS 16. And the name of the standard was the property, plant, and equipment. Why I'm writing this? Because we are going to compare the classification criteria with this investment property IS40, which we are going to do now. So IS 16 property, plant, and equipment was the tangible non-current asset thing. And we discussed the classification criteria in which we studied that these tangible non-current assets are the assets which are held for use in the production or the supply of goods or services and for rental to others or for administrative purposes. For use in the production, such as we talked about the machinery, in fact, even the plant. So the supply of goods or services, we took the example of the vehicles. Rental to others, we talk about the rent a car arrangements, rent a buses arrangement. And then administrative purposes, we talked about those computers, fixture fitting, etc., all those things. So in IS 16, we studied the property, plant, and equipment, and those were the tangible non-current assets which are held for use in the production or the supply of goods or services or rental to others or for administrative purposes. And then we talked that these assets will be giving benefit to the entity for more than one accounting year, for more than one accounting period. That is why we call them the non-current assets. And these were the property, plant, and equipment. Now we are going to discuss investment property. Now, as the name suggests, these are the property and which is for the investment purpose. Now, first of all, we will be looking at the classification criteria of the IS40, which says that investment property is the property, first of all, land or building, or a part of building, or both. Now, it's the property, as the name suggests, it's the property, investment property, land or building, or a part of building, or both, which is held for capital appreciation or to earn rentals or both, rather than for use in the production or supply of goods or services or for administrative purposes, and sale in the ordinary course of business. Now, how this is different from IS 16? The question is this. When it is the property, why we are not classifying this in IS 16? When we already have the standard for the property, plant, and equipment, why having an entirely different standard for the investment property? The answer to this question is simple. That in the IS 16, we were having the assets which were used in the production or the supply of goods or services or for administrative purposes. This was IS 16. But IS 40 is entirely different. Here you are having only the property first thing, property. There's no plant, there's no equipment, only the property, which is the land or the building or both, and which is held for capital appreciation. For example, the entity is having a piece of land and they have kept it for capital appreciation. Now, capital appreciation means that they want to get the benefit of the increase in the market value. Let's assume ABC company, they bought a piece of land and the objective is that the land will appreciate over the year. Its value will rise in the market. This is known as the capital appreciation. Or to earn rentals, for example, they're having a building or a part of building which they have given on the rent and they are earning the rentals from it. If that is the case, then we are going to classify this in the property investment property, not the property, plant, and equipment. So listen again, investment property is first of all the property is either the land or the building or the both, which is held for capital appreciation. That simply means increase in the market value, or for the rentals, or both. Like for example, if you're having a building and you have given that building on the rent, it is going to generate the rentals as well as its value will rise over the time. So here both are being met, like you're earning rentals as well as having the capital appreciation. But there's a question which can come to your mind, that when we were discussing the IAS 16, we also talked about this thing, that IAS 16 property, plant, and equipment are the assets which are being given to others on rent. And the same story is over here. You are having a land, the building, or a part of building to earn rentals. Now, what is the difference? Why having an entirely different standard when both cover the rentals? The answer to this simple question is that in the property, plant, and equipment, it can be a plant which is being given on the rent. It can be an equipment which is being given on rent. It can be any asset. For example, it can be a generator, it can be a car, it can be a bus, it can be an equipment. But when you're talking about IS 40, it is specifically a property which is being given on the rent. And you can understand this point that in IS 16, you have the ordinary course of business, ordinary activity of the rental. Like, for example, you have a rent a car business. Now, this is your ordinary activity. Those cars are generating the revenue in the ordinary course of business, for in the ordinary activity of the business. The business of the entity is to give the cars on the rent. So these are the differences that you need to understand, that even within IAS 16 we talk about rental to others, and here in IAS 40 we are talking to earn rentals, but this is a completely entirely different context. Here we are particularly talking about the property, and we are not talking about the equipments, we are not talking about the plant, etc. We are talking about the property, which is land or building or both. So this is the criteria that you need to understand, and this is what it differentiates the investment property from the IAS 16. That is why we are having an entirely different standard for it. Now, this is an extension of the previous slide. The definition would therefore include, this is an extension of the previous slide. The first point, land held for currently undetermined future use. Now, let's assume an entity bought a piece of land. They are yet to decide the use of it. They're yet to decide the use of it. For example, they may construct a building on it, or they may keep it for the capital appreciation, and they may sell it at a higher price in the future, but they have not decided anything yet. If there is a piece of land, or for example, you can say if there's a property which is held for currently undetermined future use, then that will be recorded in the IAS 40. Now, what is the reason behind that? For example, you have a piece of land and you have not decided the use of that yet. Why it should be classified under IAS 40? Because the standard says that if you have a property regarding which you are doing nothing, then it may get appreciate over time. So the capital appreciation is only covered specifically by IAS 40. So that is why you are going to record it under IAS 40, land held for currently undetermined future use. Now, when we are particularly talking about the land, you know that the land is not depreciated. Land is not depreciated. That is not going to lose its value in terms of the depreciation. It usually have the appreciation in it. So when it comes to keeping a property for undetermined future use, probably it will be having an appreciation, and that is why it is being recorded under IAS 40. The second point is a building leased out under an operating lease. Now, under an operating lease means simply the rental arrangement. Now, you probably know that lease is actually a relationship between the lessor and the lessee. The lessor means the one who is giving the asset on the lease, and the lessee is one who is taking the asset on the lease. The lessor will be getting the payment, the lessee will be getting the asset for the use. So when it comes to an operating lease, that means you are giving the asset on the lease for certain number of years. And the asset still belongs to the lessor. The lessor is the one who is giving the asset on the lease. For example, I am having a building and I have given that building on the rent to someone for, let's assume, for 10 years. Now, this represents an operating lease arrangement. Operating lease is simply a rental arrangement where I have given a building on rent to someone for certain number of years, but after some certain number of years, the building will be returned. It still belongs to me. The one, it still belongs to the lessor. Lessee is only having the right to use that building for certain number of years. So remember, this operating lease arrangement is actually a rental arrangement. A building leased out under an operating. Nowadays, even the lands, like lands are being leased out under an operating lease. Like I see usually, for example, you talk about in my country, in developing countries where there's a lot of parking issue. There are no parking plazas type things. So we see that, for example, there is a building, huge building, and there is an associated piece of land with it, and the land belongs to someone else, but the plaza owner, the building owner, has taken that piece of land on the rent just to make sure that they park their cars over there. So nowadays you see open dhabas, open food stalls in the land which is being rented out. So a building leased out under an operating lease is going to be a rental arrangement, and that should be classified under IAS 40. And the third point, which we have already studied, is land held long term in order to benefit from increase in the market value. This is what we call the capital appreciation. It also includes property which currently under construction but will be used in the future to earn rentals or for capital appreciation. Let's assume we have bought a piece of land and we are constructing a building on it, and we already know that once the building is complete, we are going to give this building on the rent. So when we already know the use of it, that it is going to be given on the rent, or we are going to keep it for the capital appreciation, then from the very start this will be recorded under IAS 40. So it also includes the property which is currently under construction. The work is going on, but will be used in the future to earn rentals or for capital appreciation. That means you already know that it is going to be given on the rent, and or it is going to be kept for capital appreciation. So from the very start, you are going to keep that property under IAS 40. Okay, now we have the fifth point, which is again very important, and it is related to the consolidation. And you already know that when it comes to consolidation, it's about the parent and the subsidiary. Consolidation is regarding the parent and the subsidiary. Why we do the consolidation? Again, you have the knowledge of that the consolidation is an application of the single entity concept. Like the parent company has acquired more than 50% shares of the subsidiary, which gives the parent company the control. Control thing means that the parent company has an authority, has an autonomy to take the decisions regarding the subsidiary. And those decisions are either financial decisions and operating decision, all those things. The parent company, by acquiring more than 50% shares, got the complete control of the subsidiary. And when we say control, it means the decision making. So due to that control thing, we say that in fact, it's a single entity. The parent and subsidiary in substance is a single entity. So their financials should be clubbed. Their financials should be consolidated and presented as a single entity. That is why we do the consolidation. And you also know, you are already aware of this fact, that when it comes to consolidation, we eliminate the intra-group transactions. Again, the basic the basic is same. Why we eliminate the intergroup transaction? Because one entity does not transact with itself. Like for example, I cannot say that I have given a loan to myself. I cannot say I have sold an asset to myself. So there's a concept related to that, that a building held by a parent and leased to a subsidiary, and we are talking about an operating lease currently. A building held by a parent and leased to subsidiary. For example, a building is owned by the parent and they have given this building to a subsidiary on an operating lease arrangement, that is the rental arrangement. So you see, when a parent has leased out a building or a property to the subsidiary, in the books of the parent, in the individual books of the parent, in the individual financial statement, it is going to be recorded as the investment property, right? It is going to be recorded as an investment property because the parent has given the building to the subsidiary on rent. So in the individual books of parent, it is going to be recorded as the investment property. But when we consolidate the financial statement, we are going to record that property under IAS 16 and not the investment property. The reason, the reason is we consolidate the financial statements of parent and subsidiary based on the fact that in substance they are a single entity. So when they are a single entity, then one entity does not transact with itself. That is why, keeping in mind the single entity concept, we are going to record that thing under IAS 16 and not the investment property. So this is the very important point that you need to understand. And the last thing regarding the classification criteria, that it is possible that, for example, the company has a building. Let's assume this is a building and it has multiple floors. Let's assume there are 4 floors of this building. On the first floor, there is an office of the company. On the second floor, there is a warehouse of the company. On the third floor, the company has given the residence to their employees as a benefit. The fourth floor was empty, so the entity decided it to let it out. That means giving on the rent. So now how we are going to record this building? Okay, the first floor is for the office. We know that this is for the administrative purpose. Fine. The second one is the warehouse, which contains the inventory of the company. Again, it is the business use. The third one is being given to the employees for the residence as a benefit. Again, it's a business use. So these first 3 floors should be recorded under IAS 16. Now the fourth floor is given on the rent. And we know the building is a part of it's a property. So a part of building is given on the rent. This should be classified under IAS 40. Now, if the question is coming to your mind that how we are going to value it, now this is possible. Nowadays, you see the huge buildings on the different floors. There are offices. In some floors, there are apartments. In some floors, there are shops. So nowadays, it is possible even to measure, a space within a huge building. Like when you go to the different malls and different plazas, you see that on the outside the shops, even the premises are being let out where you have the food stalls and things like that. Those are even sold to those persons. So within the building, the complete floor can be valued. It is possible nowadays. So when you see the complete floor is being given on the rent, that particular floor, that part of the building will be classified under IAS 40, and the rest will be classified under the IAS 16. All right, now we'll be doing an example. A rich company owns a piece of land. The directors have not yet decided whether to build a factory on it for use in its business or to keep it and sell it when its value has risen. So when they have not decided yet, you already know this is undetermined future use. Undetermined Future use, and when we talk about the undetermined future use, we have already discussed that this comes under IAS 40. Would this be classified as an investment property under IAS 40? Yes, this is going to be classified under IAS 40, and I've given you the reason for it. That it's a piece of land; it cannot be depreciated. So when you keep it for a certain number of years, even if you have not decided the use yet, it still may get some appreciation. So that appreciation actually uh, appreciation meets the criteria of IS 40. That is why we got a reason to classify that thing under IS 40. Now we have the exclusions, the assets which are not going to be classified under IAS 40. The following are not investment properties. So these are excluded. These cannot be classified under IAS 40. The first thing is property held for sale in the ordinary course of business or in the process of construction or development for such sale. That is going to be recorded as IS2. Let's assume I own a construction company and I I construct the properties, and once those properties are being constructed, then I sell it. So it's the ordinary activity of my company to construct the properties and then sell it. So that cannot be classified under IAS 40 investment property because this is my ordinary activity of business, ordinary course of business to construct the properties and sell it. Even sometimes it may happen that I just started to construct a property and some customer came and said, can you show me what you are making? And then I gave you them, the infrastructure. This is the house, this is the property, this is the thing I'm going to construct. And they say, okay, I'm going to buy it, even if you have not constructed it yet. Once it is completed, you can give me the control and this is the payment. It is possible that I have not constructed it yet and it is being sold. Yes, nowadays it happens when it comes to, the construction companies. They just announce a town, and even if it is not being constructed, the houses are being sold. So the property held for sale in the ordinary course of business. It's not the investment property. Owner occupied property, we know this is IS 16, including property held for future use as owner occupied property, again IS 16. Property held for future development and subsequent use as an owner occupied property. Like you are constructing something, you are making something, and you know that this will be used under IS 16 in the future. Property occupied by the employees. I've given the example for example, the property, the floor which is being given to the employees as a benefit for the residents. Now, if the company has given that entire floor to the employees for residents, but not as a benefit, but on the rent, then that means it is going to be classified under IS 40. But if it is being given as a benefit, then that meets the criteria of the IS 16. And owner occupied property awaiting disposal. Like there was a property which was being used for the business, and now the business had decided to sell it. In that case, it is going to be recorded in IFRS 5. So this particular point is related to IFRS 5. This is a separate standard, a non-current asset held for sale and discontinued operation. The rest of that will be classified under IAS 16. And now the third point, which is very, very important, property leased out under a finance lease. Now, going back to the slide where we discussed the lease, I told you that lease is an arrangement between the lessor and the lessee. Lessor is providing the asset and lessee is making the lease payments against that asset. In the operating lease, I told you that this is a rental arrangement. I'm giving the asset on the lease for a certain number of years, but still the property belongs to me. I will be taking it back for after certain number of years. So it's a rental arrangement. But if the property is being leased out under a finance lease, now both in the operating lease and the finance lease, lease payments are being made. Lease payments are common in both types of leases. In the operating lease, you make the lease payments. In the finance lease, you make the lease payments. The difference is that in the operating lease, it's a rental arrangement. Those payments which we are getting, we record it in the profit or loss as the rental income. But when it comes to the finance lease, here this asset belongs to the lessee rather than the lessor. We are giving the asset to the lessee. The lessee is going to control that asset. That asset belongs to the lessee, and they will be making us the lease payments. Like for example, nowadays, many property companies are doing that. Like for example, if you want to buy a house in a town, for example, you are going to make an advance payment, which is an upfront payment, and the rest will be paid up in installments. Once you have paid all the installments, the control will be transferred. Even nowadays, the control is being given at the inception of the lease. Like, for example, you have bought a piece of land and they say you can now start your construction, but the legal title will be transferred once you have made all the payments. So in the finance lease, it is the lessee who is going to control the asset. The asset belongs to the lessee. The lessor is just receiving the lease payments. So when you talk about the operating lease arrangement, it comes under IS 40 because it's a rental arrangement, but not in the finance lease, because in the finance lease, although you're getting the lease payments, but once those lease payments are done, the lessee will take the entire control of the asset. Even nowadays, I've given an example. It's from the very start that the control is being transferred to the lessee. So at the inception of the lease, the lessor will de-recognize the asset, and now it is going to be the lessee who is going to record the asset in the finance lease arrangement. So just to summarize it, that operating lease is a rental arrangement in which the lessor is going to record the asset, and those assets will be recorded under IAS 40, and those rentals will be recorded as the rental income in the statement of profit or loss of the lessor. In the finance lease, the control of the asset belongs to the lessee. The control belongs to the lessee. That is why the lessee is going to record those assets, and lessor is only going to record those lease payments which they will be getting. So the asset belongs to the lessee in the finance lease. So lessor cannot record the asset in that case. They are only going to record the lease payments which they will be getting. And we know that in the accounting, we talk about the control and not the legal title. So even if the legal title remains with the lessor, the legal title is not the story. In accounting, we talk about the commercial substance. We talk about the economic reality. So it is going to be the control which decides that who is going to record the lessee. So the control is with the lessee. That is why the lessee is going to record the asset under the finance lease. So this is the reason why the property under the finance lease is excluded from the IAS 40. Okay, now we have the recognition thing, and we have already discussed this thing in IAS 40, that in IAS 16, sorry, that whatever asset it is, it should meet the criteria of the asset first. Like putting it into any standard is the next step. For example, there's a property, okay, you have to see where you're going to classify it, under IAS 16 or IAS 40. That is the second step. The first step, that it should meet the criteria of the asset. And the criteria is what you know, that there should be a control, and economic benefits are probable, and the cost can be reliably measured. So this is the criteria which should be met first, and then there will be a story of classifying that thing into a particular standard. Then you have the measurement at recognition. Measurement at recognition means the initial measurement. The initial measurement, just like IAS 16, is going to be at cost. And we have discussed this thing in quite detail in IAS 16. The initial measurement is going to be at cost, and cost including directly attributable expenditure and transaction cost. Then you have the measurement after recognition, which simply means subsequent measurement. So if you remember, there were two models in IAS 16 when it comes to the subsequent measurement. Those were the cost model and the revaluation model. Just like IAS 16, we have the two models over here, and the entity needs to choose between two models. And I've already told you that when the entity is choosing between two models, it is going to be their accounting policy. And when it comes to accounting policy, there should be a consistency in the application of the accounting policy. There should be a consistency. Consistency means once they choose a model, they should consistently apply that model over the years, unless and until the change is required. IS 40 requires an entity to choose between two models, and these two models are just like IS 16, cost model and the fair value model. The good news is the cost model is exactly the same what you have studied in IS 16. Cost minus its accumulated depreciation minus impairment. But there's one thing you need to understand, that if you talk about the land, whether it is in IS 16 or IS 40, it is never depreciated. So just don't think to depreciate the land. Whether it is in IS 16 or IS 40, it is not going to be depreciated. Whether it is in the cost model or the fair value model, it is not going to be depreciated. So in the cost model, it is just like IS 16. You take the cost, you deduct the depreciation, you deduct the impairment, just like IS 16. But the fair value model is entirely different from the revaluation model you have studied in IS 16. And what are the differences? We are going to discuss those differences in a while. So whatever policy it chooses should be applied to all of its investment property. That means you're going to apply the accounting policy based on the consistency principle. Now the cost model is same. Investment properties accounted for using the cost model are held in accordance with IAS 16 at cost, less depreciation, less impairment loss. These properties cannot be revalued. So the properties which are held under the cost model are not revalued, cannot be revalued. And then you have the fair value model. Now, before discussing the fair value model, let me just explain to you what we studied in IAS 16 revaluation model. In IAS 16, the first thing we discussed was the regularity, how frequently the asset should be revalued. And in the IAS 16, the standard gave the guideline that the asset should be sufficient, the asset should be revalued so that the carrying value and the fair value does not differ materially. This was the guideline, this was the guidance provided regarding the regularity of the valuation in IAS 16. It should be revalued on a sufficient regular basis so that the carrying value does not materially differ from its market value and the fair value. So this was the thing over there, that the regularity is in a way that the carrying value should not differ materially from its fair value. But when it comes to IAS 40, it says the asset is revalued to fair value at the end of each year. Every year it is going to be revalued. The second thing we discussed in IAS 16 was that the gain or loss, which is the difference between the carrying value and the fair value, is going to be recorded in the other comprehensive income. And we discussed that these are the unrealized gains. But when it comes to IAS 40, the gains and losses will be recorded in the profit or loss rather than other comprehensive income. So that means these are classified as the realized gains rather than the unrealized gains. The third thing we discussed in IAS 16 was that the assets which are held under the revaluation model are depreciated, and the depreciation is charged on the revalued amount and the remaining useful life. Now, in the IAS 40, no depreciation is charged on the assets which are held under the fair value model. So these are the three differences that you need to understand: the regularity thing, the gain or loss thing, and the depreciation thing. And how to determine the fair value? Now, this is the same as IAS 16. When you are determining the fair value, it should not be it should not be decided by the entity itself. It should be derived from the active market. It should be derived from the active market. Now, active market simply means where the buyers and sellers are available. Active market simply means where the buyers and sellers are available, where the prices are available, and where the similar and identical assets are being traded. And there's one more thing that you need to understand is the fair value is normally established, is derived by reference to the current prices on active market, not the past ones, not the old one, the current prices, the current market indices for properties in the same location and condition. You know, this matters a lot. For example, let's assume there's a complete lane and there are 10 houses in it. The one which is on the corner usually has the more value than others. So there are many factors in which the value becomes different from even the rest of the houses in the lane. So for the properties in the same location and condition, so it is not the value which is being derived by the entity itself, it should be from the active market. Okay, now we have an example. Celine, a manufacturing company, purchases a property for $1 million on 1st January 2001 for its investment potential. Purchases a property, right? 1 million for its investment potential. That means the objective is to keep that for the investment. That is why it should be recorded under IAS 40 investment potential. The land element of the cost is believed to be 400,000, and the building element is expected to have a useful life of 50 years. So you see, it's a property, and within the property is the land and the building. The total worth of the property is 1 million. And it says the portion of the land is valued at 400,000 and the rest of the 600,000 belongs to the building, which has the useful life of 50 years. At 31st December 20X1, which is the year end, local property indices suggest that the fair value of the property has risen to 1.1 million. The market value is now 1.1 million. Show how the property would be presented in the financial statement as at 31st December 2001 if Celine adopts the cost model and the fair value model. Now, obviously, they're going to choose between one model, but now in the question, we have to show the both of the extracts. In practice, they're going to choose one, either the cost model or the fair value model. Now, you know, in the cost model, it is just like IAS 16, cost less depreciation and less impairment. And you're not going to revalue the asset in the cost model. Land, in any case, it is not depreciated. So the cost is this, and then the depreciation. Land is never depreciated. So the cost of the building is 600,000. When you divide it by 50, it is going to give you 12 5 the 60. Yes, it is going to give you 12,000. 12,000 is the depreciation. So the carrying value would be 400,000, and then this 5,88,000, and the total carrying value is going to be 9,88,000. This is the treatment under the cost model, where you're going to record the asset as cost less its depreciation. And then when it comes to the fair value model, no depreciation should be charged. Every year it should be revalued, and any gain or loss should be recorded in the profit or loss. So what is the cost? The cost is 1 million. The fair value now is 1.1 million. The difference between these two is the gain, which is 0.1 million, which should be recorded in the profit or loss. So the double entry would be debit investment property by 0.1 million. You're going to increase it, and credit profit or loss, which is the gain recorded at 0.1 million in the profit or loss. Okay, now we have another example. In the light of the poor market interest rates and the dip in the property prices, the financial controller of the Abbott Incorporated was instructed by the managing director in June 2008 to invest some of the company's surplus cash in a plot of land costing 1 billion. So they were having a surplus cash, so they decided to buy a piece of land, and that costed them $1 million. This land may be used by Abbott Incorporated in the future to build a new factory, or it may be sold to realize a profit depending on the property prices in the coming years. So that means this is clearly undetermined future use, that they have not decided yet what to do with the piece of land, the plot of land. They can either build a factory on it, or they can sell it in the future at a good price, but that depends on the future prices. They never know what is going to happen. So this is the case of undetermined future use. And when there is a case of undetermined future use, it should be recorded under IAS 40. Now the question is that although we know that it should be recorded under IAS 40, the initial measurement is at cost. That is fine. Initial measurement, we can just write it over here. Initial measurement is at cost. In the subsequent measurement, there are two models: the cost model and the fair value model. The initial measurement is at cost. Okay, it should be recorded under IAS 40, and the cost will be 1 million. Now the entity needs to choose between the two models in the subsequent measurement. Either it is going to be the cost or the fair value model. Okay, moving further. It is now the year end, 30th June 2009, 1 year after they have purchased the land. And the financial controller is preparing Abbott Incorporated financial statements for presentation to the board. He knows that the land has fallen slightly in value to 9,50,000. When they bought it, it was for 1 million, and now it's 9,50,000. But is unsure how to account for it. And you know, like, it is a strange thing always in the question that the financial controller is unsure how to account for it. In the SBR, it says the finance director is unsure how to account for it. And then I always think that uh, if they are unsure regarding the treatment, how they became the financial controller and the finance director. But anyways, this is not our topic. Unfortunately, they became the financial controller, and now we need to tell them what to do with the property. So we will be telling them that this is the case of undetermined future use, and it should be classified under IAS 40. And the initial measurement should be done at cost. We'll be telling them. And then we'll be telling them in the subsequent measurement, you can choose between two models, the cost model and the fair value model. And then we'll be telling the financial controller, look, we are going to tell you something special. That something special is that when you purchase the plot of land, it was for 1 million, and now it is for 9,50,000. So if you're using the cost model, if you're choosing the cost model, then in the cost model it is going to be the same thing, 1 million to 1 million, because in the cost model, we do not revalue the property. So it is going to be still available at 1 million if you choose the cost model. So by choosing the cost model, you can avoid the losses which the entity has made, in fact, in substance. And this is going to be the fine treatment. It is going to be the fine treatment if they are doing that. They're following the cost model. Okay, fine. Yes, let's keep it at 1 million. No revaluation. If they're choosing the fair value model, they have to record the property at 9,50,000. and that 50,000 will be reported as the loss in the profit or loss. But the benefit they may get by choosing the fair value model is that if in the future the value is rising, they will be able to show the gain as well. Let's assume after a year, the property is now at 1.1 million. They will be able to take it to the 1.1 million if they are choosing the fair value model. So they will be able to depict the current market prices. In the cost model, now they will be able to hide the losses. But in future, if the property value is increased, they won't be able to show the increase as well. So that is why they have to decide now that the initial measurement is done at cost. In the subsequent measurement, they have to choose between two models, either the cost model and the fair value model. Okay, now we'll be discussing transfers to or from investment property. Now, again, this is something very important. This is something very practical, and it is based on the common sense. Let me give you an example. For example, there is a building which the entity is using for the office building. Now the entity has made a new building, the purpose-built building. They are transferring their office to the new building. And this previous building will be vacant. So they have decided to let it out. They have decided to give this building on the rent. So when they were using this building for the office, this was classified in IAS 16. And now they are moving their office to the new building. And this building will become vacant. And when it becomes vacant, they are going to give this building on the rent. So when they will be giving this building on the rent, then it should be classified under IAS 40. So that means the property is going to be transferred from IAS 16 to the IAS 40. Or it can be a vice versa situation. For example, you give the building on the rent, so it was classified under IAS 40, and now you need another office. So what you have done is you gave the notice to the tenant that you can leave next month, and now we'll be making an office over here. So the tenant left, and then the building was made another office. So that means that building which was previously being given in the rent, which was classified in IAS 40, is now being transferred to IAS 16. So it is possible that a property is being transferred from IAS 16 to IAS 40 or IAS 40 to IAS 16. Now, the good news and the easy thing is that if it is being transferred from the cost to cost model, we know that the cost model of both the standard are same. So there is not going to be any change in the accounting. The property will be transferred from IAS 16 to 40 and 40 to 16 at the current carrying amounts, and it continues to be depreciated because both of the cost models are same cost minus its accumulated depreciation. So if it is the movement from cost to cost model, there is not going to be any change in that. Now, if the property is being transferred from the IAS 16 to 40 and it is being transferred from the revaluation model to the fair value model, then we know that both of the models are different. Then how to deal with it? The standard says when you are transferring the property from IAS 16 to 40 revaluation model to the fair value model, at the date of transfer, you are going to revalue it as per IAS 16. The date on which you are transferring the asset or intends to transfer the asset from 16 to 40, revalue it as per IAS 16. When you are going to revalue it, there's going to be a revaluation surplus, revaluation gain or loss thing. That is going to be recorded in the equity. That means the other comprehensive income and the revaluation surplus, because the property is still in IAS 16. Then transferred into the investment property at fair value, whatever it is. Then transfer the property into the fair value. The subsequent gain or losses, that means once the property is being transferred to IAS 40, The next gains or losses, subsequent gains or losses will be recorded in the profit or loss, and there will be no depreciation further. So listen again. Cost to cost model, no change because both of the cost model are same. If the property is being transferred from the IAS 16 to 40, remember, from revaluation model to the fair value model, the standard says that you have to revalue it at the transfer date. Because the property is still in IAS 16, any gain or loss will be recorded in the profit, in the other comprehensive income and the revaluation surplus thing. Then transfer the property to the investment property at fair value, which is the market value. Any subsequent gain or loss will be recorded in the profit or loss because now it is an IAS 40 and there will be no depreciation. Similarly, when the property is being transferred from IAS 40 to 16, the fair value model to revaluation model, revalue it as per IAS 40. That means at the transfer date, you are going to revalue it. Any gain or loss will be recorded in the profit or loss because the property is still in IAS 40. Then transfer this to the property, plant, and equipment at the fair value. Any subsequent gain or loss will be recorded in the comprehensive income because now the property is in IAS 16. And there will be depreciation as well if it is a depreciating asset such as building. So this is very important to understand that the cost to cost model is no change because both of the cost model are same. If it is from revaluation model to the fair value model or the fair value model to revaluation model, we need to revalue it on the transfer date. Any gain or loss over here in the first case, in IAS 16 to 40, will be recorded in the other comprehensive income and revaluation reserve because the property is still in IAS 16. Then transfer the property on the fair value to IAS 40. Any subsequent gain, that means after transferring it to the investment property, the subsequent gain or loss will be recorded in the profit or loss and there will be no depreciation. When it is from IAS 40 to IAS 16, revalue it as per IAS 40. Any gain or loss will be recorded in the profit or loss because the property is still in IAS 40. Then transfer it to the PPE using the fair value. Any subsequent gain or loss will be recorded in OCI and there will be depreciation as well. An example that will make you clear the complete concept. First of all, a correction. This figure is 30th June 20x9. And now we'll read the question. A business owns a building which it has been using as a head office. So office, that means IAS 16. In order to reduce costs, in order to save money, on 30th June 20x9, it moved its head office function to one of its production centers. So they moved into the production center and is now letting out its head office. And now they are giving that building on the rent. So when they're giving the building on the rent, now it is going to be under IAS 40. The company policy is to use the fair value model for investment property. The building had an original cost on 1st January 20x0 of 2,50,000 and was being depreciated over 50 years because previously it was in IAS 16. So we were using the depreciation for it, charging depreciation for it. At 30th June, its fair value was judged to be 3,50,000. How this will appear in the financial statements. So it is being transferred from IAS 16 to 40. And they are choosing what? They are choosing the fair value model for the investment property. Now what? I told you that you have to calculate first the carrying value at the transfer date. Okay, how it should be done? The dates are very important. We need the carrying value at 30th June 20x9. Carrying value at 30th June 20x9. So we have to calculate the depreciation. So asset was purchased on 1st January 20x0. The first year end would be 31st December 20x0. This is the first year end. And then x1, and then x2, x3, x4, x5, x6, x7, x8. 31st December, x8. How many years these are? 0. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9. Till 31st December 2008, these are 9 years. But we need the carrying value till 30th June. Then we need to calculate the depreciation of extra 6 months, which is on the pro rata basis. So it's the 9 years and 6 months depreciation that we need to calculate. So this is simple. 250,000 is the cost. Divide by how many years? 50. Multiply by 9. This will give you the depreciation of 9 years. Then again, 250,000 divide by 50 multiply by 6 by 12. This will give you the depreciation of other 6 months. So what is the carrying value? Take the original cost. 9 years depreciation is 45,000. The 6 months depreciation is 2,500. So at the date of transfer, the carrying value is 2,02,500. Now going back to what we have studied. This is being transferred from IAS 16 to 40. And I said revalue it as per IAS 16. At the transfer date, it is being given that the fair value is 3,50,000. So revalue it as per IAS 16. The difference between the carrying value and the fair value is the revaluation surplus, which will be recorded in the other comprehensive income because the property is still in IAS 16. Then the standard says, now transfer the property to IAS 40. So IAS 16 to IAS 40 on what value? The fair value. This becomes the fair value. Let's assume if at the end of the following year, that means after 1 year, the building is found to be 3,80,000. Let's assume by the end of the next year, now the fair value is 3,80,000. This is the subsequent gain which should be now recorded in the profit or loss because now the property is in IAS 40, not IAS 16. So the treatment is simple. When you are transferring it, revalue it as per IAS 16. Any gain or loss will be recorded in other comprehensive income because the property is still in IAS 16. Then transfer it to the fair investment property at fair value, and the subsequent gain or loss will be recorded in the profit or loss and no depreciation. The disposal is just like IAS 16. When you are disposing the investment property, de-recognize it from the books and record the gain or loss, which is going to be the difference between the carrying value and the proceeds. The last thing you need to understand regarding every standard is what you need to disclose in the notes to the financial statements. So this is what you're using. Either you're using fair value model or cost model, the rentals, the assumptions, each and everything. Just give this a read. So this is all about IAS 40.